Everyone thinks 401k is a great retirement vehicle. It's just not true. There's no guarantee that that money that's accumulating in the stock is going to go up. Like I just said, it could go down.
Yeah.
In a policy, it's guaranteed to do one thing and one thing only, go up.
So what am I missing? How does it get a guaranteed rate?
I always know when the light bulb goes off, and it hasn't happened yet for you. So like, this is probably going to happen here.
What's up, wealth builders? Today, I got myself a man of many talents. This guy is in the insurance game. He's in the real estate game, and he's in the content game. He's someone like me who just could not have a job and then has done a lot of different things. I've got Mr. Burr. How the heck did you get that name, dude?
Dude, thanks for the intro, man.
Yeah.
Pleasure to be here. It's crazy. I love what you're doing with the podcast and helping people and just getting the education out to the people, you know, helping people. So that's what I'm all about. And hopefully this does that for people. So
yeah.
How'd I get the name Mr. Burr? It's actually my name, Devin Burr. It's not spelt the same. So it's B-U-R-R. And I was doing real estate investing. I did wholesaling, flipping, early 2020. No marketing dollars. I was just going to meetups and local events and JVing deals. And then I noticed, I'm making some pretty good money because I'm not spending it for marketing, right? But I'm paying a lot of taxes. I know how taxes work. Like I was capital gains, right? Short-term capital gains. Yeah. So I'm thinking, how can I become more wealthy? And it's by holding on to properties, right? So I knew there was the method, the Burr method. And I'm like, I am Devin Burr. How about I be Mr. Burr? Because that's who I am. Yeah. I just coined myself as it. I started making shirts. I made a necklace.
You got the chain.
I got on my all my coats. I do the embroidering so I can write them off.
You got it right there?
Yeah. So this is Mr. Burr. Oh, it's on this side.
Oh, that looks good.
Made for Mr. Burr.
I like that.
So yeah, just started just coining myself as that guy and was getting deals sent to me. And again, no marketing dollars. So was able to keep a lot more of the money and build wealth pretty quickly in 3 years. Yeah.
So today, I mean, obviously you guys have done real estate stuff, but really where you've kind of made your money the last 3 years is through insurance, and more specifically whole life insurance, where you've sold the third most policies in the nation in just the last 3 years.
Crazy.
How do you do that? Like out of nowhere? Like how does one become the third biggest whole life guy in just 3 years?
The power of this thing.
Yeah.
This is, everyone looks at this at all times. They're attached to it all the time, right? That's where attention's at. So I figured I need to go where attention is, which is social media. It's a free platform. So I just started putting out content about infinite banking and what I do and how I use money and how I build wealth through whole life policies. And it's, whenever I say whole life, people are like, ugh, that's a bad word. It's not your normal whole life. We lower the death benefit, so you're paying very little cost, and then you overfund that actual policy to get cash value. Yeah. And all that cash value is protected by the contract, which states grows tax-free, protected against lawsuits and judgments. And then, by the way, we all die at some point. It also gives a death benefit. Yeah. And then it grows at 3.25 guaranteed minimum plus dividends. So it's a better place to store money. I just started talking about that and grew a following really quickly. Within, I'd say 2 months, I had like 300,000 on TikTok. Wow.
Just talking about infinite banking, whole life.
Yeah. How it works, how I use it with real estate. And then everyone just started asking how to get it. They're like, I want one. So I'm like, at first I was just sending it to the person that I got mine from. Yeah. No inclination to like monetize it. I'm just like, yeah, go to Chris Noggle. That's where I got mine. Go to Chris Noggle. Go to Chris Noggle.
Chris has been on the show.
Yeah. And I sent him legit probably like 100 to 150 pieces of business in like 3 or 4, maybe a week. And then it hit me. I was like, wait, this is stupid.
Like, why am I not doing this?
Right. So I hit him up. I was in my backyard. I'll never forget this. I'm like, hey, Chris, got like 30 more people for you. But quick question, just out of curiosity, is there a way maybe we could both benefit from this whole situation I got going on? He's like, yeah, just get licensed and you set the policy up. My team will take care of the rest and you'll cut me off with a little percentage. You keep the rest of it. So that's how I've built it so fast, is just a lot of eyeballs looking at it. They go down a funnel. They get on a call with me at first, and then I just don't want to take the calls anymore. So I just hand them off to the team.
Yep.
I give up a little bit more of the commission, but I still keep the lion's share because I'm bringing in the lead.
Yeah, it's your business.
You know?
So a lot of people, like you mentioned, they hear whole life and they're like, oh man, like this sucks. This is a scam. Like it has a very negative connotation. And, you know, whole life isn't the only one that does. I mean, there's so many things I think that do, you know, whether it be wholesaling has a negative connotation to a lot of people. Realtors have negative connotation. You know, MLMs and like, you know, whenever people talk about, because like even in the insurance industry, like I've interviewed, you know, these big guys where their whole business is built on, you know, downlines. And so people don't really like those kinds of businesses. And I'm like, at the end of the day, the more I've been in business, the more I've realized I'm like, look, if you're ethically making money, I don't really give a crap how you did it. Like at the end of the day, whether you do a real job or a real career, as some people would call it, like, I don't even know what that means, but you know, people are like, oh, you know, this guy's a guru. All he does is make money in education. I'm just like, I don't give a crap how anyone makes money. As long as they're doing it ethically, I'm good.
Yeah. As long as you're not stealing from somebody else to have yours.
Yeah.
Absolutely.
Yeah.
You know, and it's funny because I actually used to get that same response when I started off wholesaling.
Yeah.
I'd be doing text campaigns and they'd be like, why don't you get a real job?
Exactly.
I'm like, what does that mean?
Exactly.
I used to have
They want you to be a busser.
Yeah.
That's a real job. And it's true though, because it's funny. I started out as a house flipper and I didn't think anything of it. It was fine. And eventually I realized like wholesalers and house flippers kind of like had this thing where wholesalers weren't really real estate investors because they weren't actually buying properties or doing anything. And house flippers and multifamily guys and landlords, like they're the real estate investors. I'm like, all right, whatever. Then, you know, I get on social media and we start doing education. And then I realized that, you know, gurus have this big stigma of, oh, these guys are making more money selling education than they are in their business. Like that's wrong. And I'm like, is it? I mean, it seems a lot more scalable than flipping. You know, I'm already flipping 100 homes a year. Trying to go flip 1,000 homes is really hard. Trying to go get 1,000 students is way easier, and I can actually help more people. So why wouldn't I just do that?
You hit it right there. It's helping more people. You're helping people with scale. So if you flip a house, you're helping a family, right? Or just yourself and your employees, and that it just kind of stops there. Right. Yeah. But if you have a course and 1,000 people do the course, if they all take the action, they'll do well. Yeah. Right. You just changed 1,000 families' lives. Yeah. So you're helping people at scale. The more people you help, the more money you make. Yep. And that's what I started realizing with when I got into infinite banking and everything, and I was talking about all these things that were helping me become more wealthy. That's all I was doing. I was not trying to monetize it. I was just trying to help. It's helped me. It's going to help somebody else. I barely graduated high school. Yep. Like barely I read one book up until I was 31 years old. Ever. What book? It was Catcher in the Rye. I thought you were going to be like, I can't remember the name. I was like, you didn't even read one, did you? It was Catcher in the Rye. It was like a school book. Yeah, yeah. And generally in school, I used to turn to the back of the book, read that, and do the book report off that. Yeah. But for some reason, Catcher in the Rye, like it hooked me. And I read that book in high school. I would just read the Spark Notes. See? Yeah. There you go. Yeah. So I figured if I could do this, anyone could do it. So I just started sharing. And then money just started following me. Yeah. I didn't have to go chase money anymore, which was nuts. Yeah. You learn the power of generating leads. Right. Because at the end of the day, right, you figured out how to get attention on social media, and then you started to see what people were resonating with, and you're like, all right, well, I'm generating all this business. Like, how do I make a business with all of this, these leads I'm generating? Right. And that's kind of how I've always operated too. It's like, I'll put out a ton of stuff on social media of just like stuff I'm doing, just like you. It's like, yo, I got this infinite banking thing going on. It's cool. It's just what I do. Yeah. And then all of a sudden people are like, dude, I want one. That's what's happening with me right now and peptides and stuff. I'm like, yeah, I've just been doing it for 3 months. They're like, dude, where do I get it? And I'm like, dude, am I going to have to So now you need an affiliate with the peptide guy. No, I don't. I literally don't have anything, but I'm just like, do I have to start the peptide business now because everyone wants it? See, you're more of like a serial entrepreneur. You start actual businesses around everything. Me, I just want the affiliate.
Yeah.
That's all. So that's what I started doing is when I had this following, I noticed that people that would do infinite banking, if they have a business, an LLC, an S Corp, whatever, it makes more sense because you can then lend to that business.
Yeah.
So you become the hard money lender for your business instead of your business getting it from somewhere else.
Yeah.
If your business was going to pay someone else interest, why don't they just pay you interest?
Yeah.
Right?
Yep.
So it makes sense to have an LLC. So what I started doing is noticing people needed LLCs. So I got an affiliate with a company that sets the LLCs up. Mm-hmm. You know what I mean?
Yep.
People needed estate planning.
Got an affiliate
for that.
Yep.
Credit repair, affiliate for that. So I don't want to start all the businesses. You know what I mean?
I'm the opposite. I don't know why I put myself through it, but I just like it.
I mean, it's a game to a certain extent, right?
Yeah.
It's a game. So like the game can be very, very fun, right? That's why you do it.
Yeah.
You don't do it for any other reason. You've got more than enough money.
Yeah.
Right? You don't need more when you get to a certain point. You do it for the fun of the game.
Yeah.
So
100%. If you're watching this show, my guess is you're probably an entrepreneur who's trying to grow your business. And for me, the best thing I ever did to grow my business was build my personal brand on social media. It's allowed me to get more revenue. It's allowed me to raise more capital, and it's allowed me to hire better talent. And if you are not currently creating content for your brand, you're missing out and your competition is. So if you want to learn to grow, my advice is to create a podcast. Now, there's a lot that goes into building a podcast and why I believe it's the best way. So I've actually created a free training that I want you to go check out. If you go to pinedamedia.com/podcast, you can go access the free training right now and see how a podcast is going to be the best decision to grow your personal brand today. So go check it out by clicking the link below, and I'll see you in the training. So let's talk about this infinite banking and whole life and everything. So you were already doing it when you started talking about it on social media. People have probably heard about it, but they still don't understand it. And even after talking to guys like Chris and others, I still am like, I kind of get it, but I don't fully get it.
Yeah.
What is it?
Dude, I think the biggest reason is because it's such a different concept. No one thinks to flow money through a life insurance contract.
Yeah.
Right. So as soon as you hear life insurance, what do you think of?
Well, I mean, like I have a term life insurance. So I just think like, yeah, I mean, when I die, then there's life insurance for that.
Yeah. So you think the benefit is the death benefit.
Yeah. Yeah.
That's what people think of. They think life insurance is a death benefit. It's called life insurance, not death insurance. Right. So if it's structured properly, it should be used and can be used while you're alive.
Okay.
Because it's got living benefits if structured properly. So basically what infinite banking is, I'll try to keep it as super simple as I can. It's just mimicking what banks do with money. Think about when you put money in a bank, do they hold it there or do they lend it out to other people?
They lend it.
As many times as they can, right? Because a deposit to them is a liability. They have to pay you in order for you to keep the money on deposit, right? So money's leaving their pocket. How do they turn that into an asset? They lend it. So they make loans an asset. So if they pay you 1%, but they lent it at 4%, what are they making?
Yeah. I wish they would lend it at 4% these days.
Right.
But they don't.
So they're just making an arbitrage on money, on our money. So infinite banking is just taking back that function. So instead of the bank doing it, you put your money in a properly structured policy. Now you're getting the compound interest and you turn loans into assets. So you borrow against this money. It's it's a pot of money that's collateral.
Okay.
To borrow from your future death benefit.
Okay.
Because they know you're going to die someday. If you never pay back your loan, they'll take the collateral and lower your death benefit.
Right.
So
they can't lose.
Yeah, they can never lose. They'll get it back in a day or in 80 years when you pass away. Right? So it's an unstructured loan. You're borrowing from your money as the collateral. There's no structure to the loan. You decide when it's paid back or if it's paid back and how much is paid back. Okay. Right? So again, you're just mimicking the bank. You put your money here, borrow against it. You're turning a loan into an asset. So you're borrowing, let's say at 5%.
Okay.
From your future death benefit.
Okay. So
now that you're controlling that money for 5%. However much you can make above and beyond that, you're keeping as a spread, just like the bank does. And the more times you can do that and the more you flow it back to the policy, the bigger the policy gets because you're flowing more money back to it that you would have, let's say, otherwise lost to the bank, right? Think about if you buy a car. You buy a car, you get a loan, you pay the bank interest, right?
Yep.
Every month on time because you don't want your credit to go bad.
Right.
But if you borrow from your policy, can't you just pay yourself that exact same payment? Now you're getting the interest the bank would have got, or you're doing an investment where you're keeping that spread and that money's going back to the policy. So it's just a place to mimic what banks do with money. That's it.
So if I'm hearing this correctly, all you're really saying is that instead of putting your money with the bank, just put it in a life insurance policy.
Properly structured.
And the benefit is, okay, if I put it with the bank, I'm going to get no return because they're just not going to pay me. But if I put it in a life insurance policy, I'm going to get a return, which we haven't really talked about how that works, but I'm going to get some kind of return. So for me, I guess what I'm trying to understand is why would I put it in a life insurance policy versus, say, just stocks or a mutual fund or something? Great
question. Few reasons.
Okay.
Insurance companies, they don't lose money. Think about what they do is they evaluate risk. That's all they do. So when you put money in a policy, when I put money in a policy, when your neighbor does, it goes into this big pot of money, billions and billions and billions of dollars. And they just invest the money into super, super sound investments because they're hedging risk all the time. So they're always profitable through Great Depression, World War I, World War II, meltdown of '08, COVID. Like you can look up these companies, profitable for like 140 consecutive years. Crazy.
That is
so
crazy.
Like, think about the stock market. If you're up 50% and then you're down 50%, you have an average return of what would be zero, right? But your actual return is less, right? If you have $50,000 and you go up by 50%, what do you have? 75 grand, right? I'm trying to do the math quick. I don't have my calculator,
right.
but then if you lose 50% off 75 grand, now you're at what, 37.5?
Yeah.
Your actual return is negative. But everyone looks at like the stock market and mutual funds. Oh, it average 8%. What's the actual? And the actual is actually around 3%. Actual returns in stock market. I think over the last 25 years.
Really?
Actual returns. Crazy. So one, you get a better return actually in a policy because it's also tax-free. So if you make 8% average and then you're taxed, you're not keeping 8%, right? In a policy, let's say you make 5 to 6, it's tax-free. So that's like you're making like 8 to 9 before taxes, right? So that's one reason. Second reason is, let's say you put money into a stock and if you can borrow against it, I don't even know if you can borrow against stocks.
You could borrow against your portfolio or like a money market, something like that.
Okay. So let's say you do that.
Yeah.
There's no guarantee that money that's accumulating in the stock is going to go up. Like I just said, it could go down.
Yeah.
In a policy, it's guaranteed to do one thing and one thing only, go up. So you always have a bigger pot of money to borrow against.
Got it. So it's safer.
And it never stops the compounding because you're not taking it, you're borrowing against it.
Okay.
You know what I mean? And then you pass away, your family gets a multiple of whatever you had put in there. That doesn't happen with stocks.
Right.
Also, it's protected against lawsuits and judgments. Stocks aren't, right? So it's a safer place. It's with companies that don't go under, that aren't insolvent like banks are. One of the insurance companies we use, 169 years in business. Like,
why do you think all these banks went bankrupt the last year? It's kind of crazy.
I mean, who knows? I think there's someone pulling some strings, right?
It's like the Silicon Valley Bank was this massive bank, been around for decades, and then just one day, they're just toast.
Here's what I think.
Okay.
And like this could be accurate, could not. Is there's this thing called fractional reserve banking.
Yeah.
So you put money in the bank, they only have to keep a fraction of it on reserves. They can lend out the rest, right? So let's say that there's all these deposits in the bank. they've got it all lent out into investments, and those investments dropped in value. And now people are starting to want their money. They go to the bank. It's called a run on a bank. They go try to get their deposits out. The bank doesn't have it. So they have to sell off assets. And now they're selling off assets at a loss, right? So that's how I think they went under, is they're selling off assets at a loss to pay us back our deposits that they didn't have because they lent them out. Cool thing about life insurance, you put money in a policy, it goes into their general funds. They can only lend out what's in that general funds.
Really?
They cannot do fractional reserve.
Got it. So they're always lending what they got.
So they're never insolvent. And again, they just calculate risks. So they don't go buy Dogecoin, you know? Like they're doing like long-term treasury bonds. They'll lend blocks of money to hedge funds or banks. So they're just doing really calculated investments. And then they don't insure everybody. If someone's about to die, they're not going to insure them because then they'll have to pay out a death benefit.
Right. They're only paying, or that's the crazy thing about insurance is like the young people pay way too much for what their true risk is because they're kind of subsidizing the older people.
Yeah, 100%.
Yeah.
But you think about this, though, the most common insurance policy is a term insurance.
That's what
you have.
Yeah.
When did you get it? How old?
Man, I was probably late 20s when I started making money.
And it's probably what, 20-year term?
Dude, I have no idea.
It's probably 20 years.
I haven't looked at it in years.
So
they made me get a blood test and all that stuff. I had to do a physical.
It's probably going to expire when you're like late 40s.
Okay.
They know without a shadow of a doubt by statistics, the likelihood you are going to die in that time frame. You're healthy, you work out, you don't live some crazy lifestyle jumping off mountains or something.
Now I'm on peptides.
Now you're on peptides.
It's like, who knows?
Let's go.
Who knows?
So they know you're not going to die.
Yeah.
You're going to outlive that contract. They didn't have to pay anything out, and you paid them for 20 years. Now, if you want to get that exact same coverage at 49, you're more likely to die in the next 20 years. So your cost goes up like crazy.
Got it.
They know that. But then even then, your likelihood of dying before like you're like 70,
still low.
Slim. So they know that. But then when you hit like 70 and you want that same exact coverage, you can't afford it anymore.
Yeah, they're like, nah, dude.
This is why they're so profitable, because they advertise term insurance because it's the most profitable. If you only have to pay it out 1% of the time, 99% of the time, you get those payments like clockwork every year, every month. Of course, it's going to be profitable. You know what I mean? So I think that's another reason why a lot of people, they don't know about infinite banking. I think everyone should know about it.
Yeah.
But they don't know about it because it's not the most profitable for the insurance company. Not the most profitable for the agent either. The agent makes a lot less money.
So why do you always hear that agents make so much money like with whole life? Everyone knows that my favorite way to build wealth is through real estate investing. That's the reason that I started Wealthy Investor, where we've trained thousands of students. But here's the thing. I've noticed that so many people fail to get started in real estate because they're worried about the money. They don't know where they're going to get the money to buy a house or flip or handle their renovations and things like that. And so they just never get started. I want to change that. And that's why I created a brand new free course that goes over 5 different ways that you could buy houses without using any of your own money today. And I'm going to give you it completely for free. All you have to do is go to wealthyinvestor.com/podcast. I've made it specifically for you. The moment you go to that link, you'll be able to go get access to it and learn how you could start buying houses today without any of your own money. And if you're somebody who already has a real estate business and who wants to scale, we want to help you too. You can click the link below and book a free strategy call with our team if that's you.
Regular whole life, agents make a ton of money.
Yeah.
So think of it like this. There's 2 parts to a life insurance contract. There's a base premium. That's like regular whole life. That pays for a death benefit. Okay. What we're doing is we're lowering that. So we're essentially lowering the death benefit.
Okay.
We're not highlighting the death benefit.
So that, you're not going to get paid as much when you die compared to.
Yes and no. So I'll get to that.
Okay.
So the death benefit gets lowered. And then that way you don't have as much costs, as much fees, as much commissions. And then what we're doing is we're having you overfund that base premium with paid up additions. It's basically like prepaying for insurance that doesn't have a cost. Okay. So you get a little bit more life insurance, but you get a bunch of cash value. Okay. And that's what you can use for whatever you want. The way it's structured is when the companies are profitable, which again, these companies are profitable every freaking year, they pay a dividend. And that dividend buys more paid up insurance. So you're essentially always getting an ever increasing cash value and an ever increasing death benefit. So like I've got a policy where I put in 125 a year. The death benefit, if it was regular whole life, 125 grand a year, the death benefit would be like 80 mil.
Got it.
It started off at 7.6. By the time I'm likely to die, it's up over the 80 mil. It's at like 156 mil. Because ever increasing cash value, you have to have an ever increasing death benefit to match it, or it's not a life insurance contract. And then it becomes taxable. So that's why it's important working with like our team is we know how to structure them to make sure they're done right. And so they don't become taxable.
Got it. So to me, what I'm hearing is by doing whole life, you get the benefit, obviously, the death benefit.
Yep.
You can borrow against it. And your, I guess, it's got a guaranteed, rate at which it's going to pay you versus a stock or something which does not.
Yep.
How does it get a guaranteed rate?
Because the insurance company just knows without a doubt they can make at least 3.25% interest.
Okay.
Because remember, you're putting all your money there and it goes into their general funds. They know they can take it and go make 5, 6, 7% like clockwork. And then also they earmark how much is going to be paid out in death claims. So like, let's say they earmark $2 billion for death claims, but they only had to pay out 1.5. That extra 500 mil is profit. So they distribute it in dividends to their policy holders. So they're just, life insurance companies are super smart. They know how to make money over an extended period of time. They do not lose money.
What does Warren Buffett do?
He has he owns a corporate owned company. So think of like there's corporate owned and there's mutually owned.
Okay.
So corporate owned has like basically stockholders, right? So people at a round table, they're benefiting from all the moves that the insurance company's making, right? Mutually owned, you buy a policy, you're a mutual owner. You're a part owner of the business.
Okay.
So me, as I've got 3 policies with 3 different companies, I am a part owner of all those companies. So what are all their decisions made for? Me, my benefit. When they make profits, who gets them? Me. I get the dividends because I'm a part owner.
Yeah.
His company is corporate owned. So like basically any profits, they get divided up with the shareholders.
Yeah.
Not the policyholders.
Right. So his stockholders get the dividends.
Right.
Who own into Berkshire Hathaway.
Right.
But if you have an insurance policy with Berkshire Hathaway, it has nothing to do with like Berkshire Hathaway's success.
Correct.
Got it.
Correct. So if they're profitable,
you don't care all you care about is your insurance.
Yeah. And they don't share the profits with you. So why would you care about if they're profitable? You just want your death benefit.
Right.
That's it.
Now, when you do whole life, the death benefit never goes away, no matter how old you are.
As long as you just keep premiums going in. So as long as you keep paying your premiums, death benefit until the day you die. Or if you outlive it, they'll just pay out the death benefit while you're alive.
Oh, really?
I fully plan on doing that. We talked about that on the way up. AI and like our level of income, like I'm going to live to be 150. It's happening.
I keep seeing all these guys say that.
Dude, I am convinced, bro. 100% convinced.
Why?
Have you like really dove into AI and just how freaking smart it is? It's going to figure some things out if it hasn't already.
Yeah, it's going to make you live to 150 before it kills you.
Right.
Yeah.
It's either going to kill you or you're going to help. It's going to help you live to be 150.
Yeah, I don't think there's an in between.
Yeah. I mean, it's true.
Terminators coming to get you.
Yeah, I'm scared about that, but we'll see. It's all about the input, right?
Either I'm living to 150 or I'm going to die in the next 20 years because of the onslaught from AI.
The robots coming after me.
Yeah.
All the movies that have been throughout the years, right? Terminator, iRobot. Like,
iRobot was a good movie.
I like that. I like Will Smith, dude. I think he's a really good actor.
Yeah, he's having a tough time right now with Jada just trashing them everywhere. But
I never follow the news. I don't I don't even scroll on social media. Like I'll be on my phone for like 8 hours on social media, and she's like, what are you doing? And I'm like, I'm working.
Yeah.
I don't scroll. So
the only reason I know is because she's been on like my friend's podcast and stuff. And so I'm like, what the heck is she? Oh, she's promoting a book. Oh, she's just trashing Will Smith to make some money. Okay.
Crazy.
I'm like, this is crazy.
Jesus.
Yeah.
And they had like the best relationship ever back in the day, from what I remember.
I don't know what to believe. As with anything in social media, I don't know what to believe anymore.
This is true. This is very true.
You walked in my office and you thought you were coming to a house. You're like, I don't know what to believe. I thought he had an office and some employees, but apparently this GPS is taking me to a house.
Oh, true story. Everyone watching and listening is I put in the address and it was like literally just a 2-story house and then a neighborhood. I'm like, I think I've seen his house on some of his like content. This doesn't look like it. It's a nice house, but like it's not as nice as the one was on there. Like, so I hit up your guy. I'm like, Jonathan, is this a house?
Does he rent that house? Is that in the metaverse? Where's his real house? So
good.
You back to the insurance, because I still truly want to understand this. So like, I have a term policy, which is cheap. I pay monthly. I don't even know what it is. But when I originally got it, it was like a few $100 a month. It was nothing crazy.
Yeah.
And originally when I did it, this was back in 2018. So that was like when I became a millionaire and I set up like all this crap. I got a trust and started having actual assets to protect. So, went down that rabbit hole. And they were like, yeah, you should get a life insurance policy. And so I had a bunch of people pitch me on just different policies. And then like, infinite banking was one of them. And I just was like, dude, honestly, it sounds like legit, but I'm just so focused on real estate. I'm not going to deal with this. I just don't have time for it.
Yeah.
And I ended up getting a term policy because I was like, all right, but if I do die, then let's make sure that my family's got something. And it was for like a couple $1,000,000. And then as time went on, I just upped it to, I don't even know what, I'm pretty sure it's like an 8-figure term policy just in case something happens. And I've just always kept it because I'm just like, look, I'm going to just go make my money doing all this other stuff. That being said, since then, especially on the podcast and everything else, like I've had Chris and, we've had other people, I don't know on the podcast, but like I have buddies now who definitely that's their core business with infinite banking. And I've read the books too. And I understand the concept of borrowing the money and everything else. What I guess I just don't understand is this concept of why do you need it if, like, let's just say you have cash in the bank. You don't need to borrow from yourself because you just have it in the bank, and so you would just use it. So what am I missing?
I love it. So this is like, this is what a lot of people ask the same question when I talk to people. And generally, like, I always know when the light bulb goes off, and it hasn't happened yet for you. So like, this is probably going to happen here is think about if you use that money in the bank. You know what opportunity cost is.
Correct.
Right? If you use that money, you've lost that money's ability to do anything else. Right? It could make you a return, which you know how to make money. So you're good at making returns. So you're not going to lose money per se.
Yeah.
But it's only doing one thing. Right?
Yeah.
If it's sitting in a policy, it's now doing two things. Your money's running parallel.
Okay.
So it's compounding and growing in a policy, guaranteed. It's not going to do anything but go up.
Right.
So then you're always borrowing more. You're not interrupting the opportunity cost of that money. And then you take it and do your investment. You're making your investment over here while the money's making money over here. You're just making money in two places.
So I guess how would this be different than, say, I mean, your name's Mr. Burr. So if you go buy a house cash, right, and the house is an asset, it's making money, you're getting rent, you're doing all that, and then you borrow against it. And so now you still have the asset's still appreciating. You may not cash flow anymore,
right,
because you have a mortgage, but you still get all the other benefits of the asset. but now you have the cash to go deploy. So you're like still controlling too.
That is infinite banking.
Exactly.
So
I get it.
You know the concept. The reason why it just makes more sense with a policy is because you have unhindered control as a policy holder, as the owner of the policy, and you can own policies on your kids, your wife. I've got 3 on my daughter, 3 on my wife, 1 on my dad, 1 on my mom. As the owner, you have full control, meaning you take a policy loan, you never have to pay it back. Right. If you borrow from your house, guess what you have to do? You have to pay it back.
Yeah.
Or they take the house, right? Because the house is the collateral. Your money you put in was the collateral. They know they're going to get it back.
Yeah, and if you have a stock and it goes down, you get margin called.
Yeah.
Yeah.
And then the other thing too is whenever you're using a policy, if you need the money, I can literally on my phone go onto one of the apps, ask for a policy loan, hit a few buttons, say which bank account I want it to go to. A couple days, I get it. Boom, no questions asked. No financial statements, no credit checks. You borrow from a house, it's going to take you some time, right? 60 days, 90 days. Rate's always going to be a little higher too, right?
Yeah.
Right now, especially 8%. Mortgage, or not with mortgage, with policies, again, they play the long game. So they're not changing rates like crazy. I've seen 5%. That's all I've seen. Hasn't gone up, hasn't gone down. That's all I've seen is 5%.
5% as far as what it will pay you?
The borrowing rate.
Oh, the borrowing rate.
So I can borrow at 5%. That's not changing like crazy because they're playing long games.
And you said the policy makes 3-ish?
Guaranteed 3.25 compounding plus dividends. So with dividends, 5-6%.
So if it made 5%, you borrow at 5%, it's a wash.
No, because you're paying simple interest, you're earning compound interest.
Okay.
So as long as you're continuing to put money through your policy, that's all you're doing. It's a place to store capital. So if you're using it, don't store it in your bank, flow it back to your policy. You're always paying down your balances, so you're accruing less interest. Right? So let's say I borrow $100,000 at 5% and I pay nothing back. I owe $5,000, right?
Yep.
That's true 5%. But let's say I paid back 50% of it. I'm only accruing interest off $50,000 now. At the end of the year, I'm going to owe less interest.
Yeah.
So for having control of $100,000, it wasn't truly 5%. The true rate might have been 3, 2, but it's compounding.
Because you didn't have it fully leveraged the whole time.
Right.
Yeah.
And you could fully leverage it. That's what I do. I fully leverage it, and then I always just flow other money from my business back to my policies. So for instance, I'll take a policy loan, easy math, $100,000, goes into my personal bank account. I then make a note from me to my business.
Okay.
So my business lends me money at 15% interest. The business now has that money. Business pays me 15%, which would be $15,000 for the year. It's going back into the policy every month, $1,250 a month.
Okay.
Right? So it's paying down that loan balance, but the full $100,000, my business is taking it and deploying it. Right? I'm just paying back interest only to myself indefinitely. I never have to pay it back.
Right.
But I'm always lowering it down. So let's say at the end of the year, I've built back $15,000, right? Because
why would it pay it down if you're only paying interest though? It wouldn't pay down if you were only paying interest though, right?
No, I'm paying interest only on the $100,000 I borrowed.
Yep.
So that would be $1,250 a month. I'm paying that down on the loan balance with the policy.
Well, but with
Make
the
sense?
policy, don't you have to pay interest too?
It accrues at the end of the year. So
Got
again,
it.
remember, if I borrow $100,000, I don't pay anything.
I understand now. Okay,
Yeah.
so if you paid off, let's say $10,000, you're gonna get interest on $90,000 essentially.
Right.
Okay.
At the end of the year, and it's your decision to pay it or not. What I do,
So what happens if you don't pay it?
it just
So does your balance?
it chips away at your death benefit.
Oh,
Yeah. So again, you never have to,
right.
but you should.
So it'll chip away at the death benefit, like the interest that it's charging.
Right.
Okay.
What I do simply is at the end of the year, the insurance company lets you know how much is owed. Let's say it's $5,000. I just write a check from my business as a business expense. I pay them $5,000, so I get a write-off. Plus the $15,000 I was paying myself back throughout the year was a write-off, right? It builds back up in the policy. Now I've got $15,000 extra. What can I do? Lend it to myself again. So now I got 115 grand lent at 15%. That's 17.5 coming off my books that year, building back up in the policy. Follow me? Mm-hmm. And that builds back up. I lend it again. So now I got 132.5 lent, and I'm paying interest down from that on my business. So I'm always just flowing money back, using it again, flowing money back, using it again. That's it. The more you do that, the bigger the policies get.
Because you're just overfunding it. That's why the policy keeps getting bigger.
Yep. Just overfunding the policy to the max. Because once you get to the max.
What's the max?
It's called the MEC 7 pay rule. So basically a calculation that each company has. There's only so much you can put on top of a base premium, a life insurance policy, before it becomes taxable.
Oh.
So just overfund. Once it gets to that line, our team knows, like, don't put any more in. And then you just have to start another policy. So
what's the max?
Amount of policies?
No, like whatever you just said, like the max before you start paying taxes.
See, that's where it gets a little confusing because there's so many different ways to write that contract. Is you decide the max. You would say, Devin, I think I could do 10,000 a year, 100 grand a year, $1 million a year, 5 million a year, whatever the number is. Mm-hmm. Let's say it's $100,000 a year. Of that 100,000, there has to be a portion for the death benefit, or it's not a life insurance contract, right? So about 30% of it's the base premium.
Okay.
30 grand. 70 grand is overfunding. Okay. So the more you put in, essentially the bigger the policy, the bigger the death benefit, but the more cash value you have. So you basically determine the limit, and then we build it to where it's not taxable.
So what would the death benefit end up being?
Really high.
But let's just say like you overfunded it $3 million. Mm-hmm. I mean, obviously you're going to get your $3 million back, but does it, like, what does the policy actually pay?
On a death benefit?
Yeah.
See, that's based on a couple different things, age and health, obviously. Like
and you said part of it is you're putting the death benefit really low. You guys aren't concerned about that.
So you're putting it low, but again, if you put in $5 million, you can't have a $30,000 premium. It'd be too much on top of that premium. It'd become taxable. So your actual death benefit, the base premium on like $5 million would have to be about like $1 million. So that'd be a really, really big death benefit. And then the younger you are, the longer it has to grow.
$1 million is the death benefit?
No, $1 million's how much you're putting in. So you put in $5 million. Of that $5 million, let's say $1 million of it goes to pay for the death benefit.
So what's the
cost?
What's the death benefit going to cost or pay out?
I don't know. That's the thing, because it's all based on your health, your age, but it'd be big. It'd be very, very big.
Like someone like me, what would it pay out?
I have no idea.
It's just a lot.
That's a lot. Like, for instance, that one policy I had $125 a year.
Yeah.
That starts at $7.6 million.
Got it.
So like, it'd be a lot.
7.6 is the starting point for like the worst.
Right. So if I put in 125 the first year and walk into the street and get hit by a train or a car, trains aren't in the street.
Yeah. we have trains on the strip now.
So yeah, my family would get $7.6 million, but I only put in 125. So the insurance company has a lot of risk early on. The longer I pay into it, the less risk they have because I've continued to put money in that they can go invest.
So what's the cost to all this? Like, how do you guys make money?
Off the death benefit cost. Remember, there's two parts. Paid up additions, which is overfunding. Base premium, which is death benefit. We're just lowering that. So we're getting paid a lot less, 60 to 90% less commissions, but we do volume, right? So I've set up 1,600 policies in 3 years. The average life insurance agent would set up like 6 a year, you know? So
what else? What are they doing? Why don't they want to sell more? What do they sell?
They sell regular term, regular whole life, but but again, because that's where all the commissions are at, right?
Got it.
So it's not sexy to sell infinite banking because it's lower commissions.
How much are their commissions? Because my term is not even a lot of money. Like it was like a couple $100 a month.
They're probably getting a couple $100 a month.
They get the whole thing.
Pretty much. Like 90% of what you're putting in.
How does the insurance company make money?
So they're not paying out of your $100. The insurance company is paying out of their general funds. So they just have allotted money for commissions, allotted money for investments, allotted money for death benefits. So insurance companies are smart, dude. They know how to freaking make money.
Have you heard of captive insurance?
Yes.
I've seen people talk about that as a way to like not pay taxes too.
Yeah. There's so many different ways, dude, to get around taxes. Like I've got like the cheat code of all cheat codes, and this is the wealthy way. So we're going to share the cheat code.
All right, let's hear it.
You might know about this. A lot of people just don't. Even when I share with really successful people, they're like, really? You can do that? It's properly structured foundations and trusts. Okay. If you have a properly structured foundation, a foundation is tax exempt, IRS tax exempt. And then if you have certain trusts in place where the beneficiary of those trusts is the foundation, you can literally avoid all taxes legally. Yeah. It just has to trickle through a system correctly to be within the tax code. So I set mine up. My business partner Sam is about to set one up. Chris Noggle has one set up. Brent Kessler has one set up. And basically, like this last year, I saved $400,000 in taxes. Crazy.
So how does that work? Like you set up a trust and a foundation. How do you guys like, I mean, how is it legal? How do you access the money? And like,
so,
I don't get it.
Dude, this could be a whole podcast topic right here, but it's to keep it simple. I've got, I think 7 companies, 7 LLCs, right? So all these LLCs are up here and they're basically owned, not by me, they're owned by my management company. Okay. So my management company owns all these LLCs. So any revenue coming in, it can charge a management fee to take the taxation off the LLC's books, right? Now it's in the management company, it holds the money. That management company, the beneficiary of it is the family trust. So I just make a distribution to the family trust, and then I can pay all my insurance policies. I can pay for my mortgage on my house. No taxes. Whatever I don't use, I can make a distribution to my business trust. For my business trust, I can use all the money. Anything left over at the end of the year, I just have to make a donation to the foundation. Donations are dollar for dollar write-off. Make sense?
Somebody was telling me with donations, now you have to, because it used to be like 100% you could donate of your income. Now it's like 50% or something. Have you heard that?
Yeah. It's that's part of it too. Is your gross income you can donate if it's cash 30%. So if you make $1 million on a W-2, you can literally donate 300 grand. So now you're only paying taxes on 700. If it's an asset, it's 20%. So you can donate an asset, 20% comes off of your books.
Yeah. Well, it used to be, I think the rule I'm thinking about is you used to be able to donate up to 100% of your income. So if you made $1 million and you truly just wanted to go give $1 million away to charity, you could.
Wow.
But now I think it's, I want to say 50% up to a certain amount of money, which I think is like 5 million.
I don't know that rule.
Someone would fact check me in the comments.
This would just be different because it's a trust making the donation to the foundation.
Yeah, I mean, I guess at that point, are you just operating your life and stuff out of the foundation?
Great question, dude. So the foundation has a 5% expenditure. So it has to spend 5% of whatever it holds in assets. Let's say it holds $1 million. It's got to spend 50 grand. So that 50 grand could be paying for that desk, paying for, you know what I mean? It could be a trip with your family to talk about the foundation.
Yeah.
Right?
But you don't need a foundation to do any of that. You could just take that right off anyway.
Right. But think about what I just said. You're only paying 5%. I paid no taxes on anything. So there's a whole bunch of money in this foundation. I just got to spend 5% instead of being taxed 40%.
But I guess what I'm saying is, how do you access the foundation's money then at that point?
Because you control the foundation. You're the trustee of it. So there's rules in place where you can't like self-deal. So I can't just like write myself a check to go buy some new J's, right? Okay. So basically what you have to do is from your businesses, you keep back whatever your lifestyle is. Let's say your lifestyle is 10 grand a month, keep back 120 grand a year. That's what you pay taxes on.
Yeah.
Everything else goes into the foundation, and then you can invest with it, make loans to your businesses from the foundation. You can do so many different things. It's crazy.
So, yeah, that's an interesting one. I guess somebody listening to this would probably be thinking, well, which one should I do? Should I do whole life and infinite banking, or should I just do that?
This is like a high level thing. It costs $95,000 to set it up. So like
Wow.
most people, like they don't have a tax problem. They have an income problem. Like if your tax bill is 40 grand, why would you spend 95? Just pay 40.
Yeah.
Right. But if your tax bill after write-offs, after depreciation, you're still paying out like $1 million a year. You have a tax problem.
Yep.
Pay 95, don't pay $1 million. You know what I mean? So for most people, it just doesn't make sense. But for people that are really high earners and they just are tapped out on write-offs, it makes a ton of sense. Infinite banking, I think, works for anybody.
I wonder if the foundation can invest or like give loans and stuff.
Yes. I'm not an expert on this, so I should have prefaced with, this is not advice.
Yeah.
This is just what I do.
Yeah.
So I'm not a tax attorney, but I have a tax attorney. And whenever I have questions, I'll like call them and ask and just make sure I can do things correctly. But yes, you can loan from the foundation.
Got it. The people in the comments are going to be like, dude, you're going to get all the fact checkers.
Oh, for sure.
Yeah.
I'm trying to, off the top of my head, it's 503C.
Yeah.
Is that what it is?
Yeah.
501c3. That's what it is. So they can look that up. That's the foundation, 501c3. And then it's filing on a 1041 tax return, not a 1040.
Got it. Yeah, we're actually in the process of getting my foundation done, but not for this. So Wealthy Kingdom, which is our Christian entrepreneur community. Right now, we've been going through it for like months trying to get it turned into a nonprofit. And I mean, just for the reason of, so we do become tax exempt. And so we're not paying taxes on, anything, and we can go out there and make it happen. And then people can actually start donating to us and all that other good stuff. So
you'll basically have the same thing. You just wouldn't have the other parts of it, the trusts. The trusts have to be structured properly to be in conjunction with the foundation for that all to work.
Yeah, but I don't want to commingle anything like
right.
Yeah, it's its own thing, just operating for its purpose. Right. But I have heard of rich people doing the foundations for the tax reasons and all this stuff.
Yeah. Bill and Melinda Gates Private Family Foundation. That's the same structure. Mark Zuckerberg has one.
So you think they're all running? They're running like their foundations as both, essentially, as like a tax haven for their own income plus whatever their passion is. I
think so, because like you think about taxes, what it is, it's social capital, right? It's either voluntary or involuntary. So like if you're using this structure like Bill Gates and everyone does, and they've got all this money in the foundation, now they can decide what that capital goes towards, right?
Right.
Curing cancer, I think he's trying to cure AIDS, right? Dude, I could be wrong.
All I know is he's buying up all the farmland, and all this conspiracy theorists want to know why.
So again, I don't read the news much, so I don't really know what's going on. But the fact of the matter is,
well, and they're divorced now.
You've got social capital, taxes. That's what it is.
Yep.
Voluntary or involuntary. So if you have it in the foundation, you can decide what it's going to go towards. If you're just paying taxes, what's it going towards?
Yeah.
It's involuntary. So I think it's a way for just people to pay less taxes for things they don't know what it's going to be for and control more of what that is, because there's that 5% expenditure.
Right.
And you have to make a donation, or you have to make a contribution to something. So it's, dude, it's crazy. The more I've learned about it, it's made everything with infinite banking just more powerful, because I'm able to flow all the money through these policies and pay them with tax-free dollars.
Why is it $95,000? Just because it's just so complex to do, and to make sure you do it the right way so you don't go to prison.
Yeah, basically. And then my tax attorney like does all the paperwork, make sure everything is correctly filed, and basically make sure I'm not in prison.
Yeah, that's what it sounds like. I'm like, that sounds intense. But back to like the whole life side. So One thing that I remember when somebody was pitching me whole life and infinite was like the first 7 years or something, you're negative.
No. That's like a regular policy you are.
Yeah. Because they were just like, yeah, I mean, this is how it works. Like you can put however much you want into it. And they're talking about the same concepts of like overfunding it and stuff. But then the problem was you're negative like the first 5 to 7 years because of the cost of the policy or something. I don't know.
Yeah, they just must not have been building it right. They probably had too high of a death benefit. Because remember, that's the cost.
Right.
So if the death benefit's lower, the growth outweighs the cost quicker. Does that make sense?
Yeah. And I think these guys would probably, I would say they were doing it with that, like a high death benefit.
Yeah. Which I don't think it's doing the right thing because, but it is at the same time because if you pass away, your family's taken care of, tax free, right? They're just doing it more for their commissions.
Yeah.
You know what I mean?
A death benefit is tax free.
Yep.
Wow.
It's income tax free. There's estate taxes, I think, over 21 mil. Again, part of the foundation. I could be wrong on this. Don't quote me, people, but I believe that also makes there's no estate taxes if it's within the structure. So that's cool too. So like if you got $30 million of a death benefit, all 30 million is income tax free, but 9 million is estate taxed. I don't even know what those rates are.
Right.
But at the end of the day, if you give your family 30 million and they're mad because they got taxed a little bit, it's like you're looking down being like, really? Really?
You know what? Let's give that back to my foundation.
Right.
These guys don't deserve it.
100%.
Yeah, that's something, man. But you got a newborn on the way.
Yeah, man. Super excited about it.
Yeah.
Super, super excited.
Are they going to be infinite banking at before one?
She's got a policy already ready in underwriting. As soon as she's born.
She just, bam, insured.
Yep. So I think it's 2 weeks old they can have a policy.
Oh, really?
Yeah.
That's crazy.
Dude, if you think about life insurance is based off compound interest.
Okay.
Compound interest just takes time.
Yeah.
Longer you give it, the bigger it gets. So if she's 2 weeks old, by the time she's our age, she's going to be filthy rich. Right?
Yeah.
And yeah, it's one of those things where like the Rockefellers, everyone knows the Rockefellers.
Yeah.
They have actually become wealthier over 9 generations.
Yeah.
How do they do that? They have trusts in place and life insurance policies. A trust basically just dictates how the money's spent when you're gone.
Yep.
Right? So if all this money comes into a life insurance or from a death benefit into a trust, but the trust says, you only get $1 million when you're 25.
Right.
You only get another $1 million when you're 30, whatever the rules are. They can't go broke because then if every person in the family has a death benefit on their life, they're going to die. Trust becomes even bigger and bigger, wealthier and wealthier. That's one thing that's guaranteed in life.
Death. People say death and taxes, but like you're talking about, you can avoid taxes. But if you live to 150, you can almost avoid death, but then you still get got.
I want to preface with this. You can't avoid taxes. Like you still have to pay them. I have kind of a cheat code.
Okay.
Like my wife is a W-2 employee.
Yep.
She makes very, very good money, enough to live our lifestyle. We donate 30% of her income to the foundation. So we pay on 70% of her income. That's enough to live our lifestyle, more than enough. So all of my money, I don't have to pay taxes on. If she wasn't working though, I'd have to keep money back to live our lifestyle. So I'd have to pay taxes on that amount. Everything else could go into the foundation and trust structure.
So you're saying that you guys live off of her 70% that she makes. 30% goes into the foundation tax-free.
Yep.
Then your money's going into the foundation tax-free. And then that money is getting reinvested into things?
Yep. Paying for insurance policies, paying for the mortgage on our house because the house is owned by the family trust.
Right.
So the bank account from the family trust can just pay the house payment.
Got it. So now you're not getting taxed on your house payment anymore.
Exactly. Because most people think I'm going to write off the interest. We're writing off the principal and interest.
Yeah. Because you're not paying tax on it.
Yeah.
Interesting. Okay.
You can do that with anything. To an extent, it doesn't make sense. With some stuff, it's higher higher liability, like a car. If you put a car in the trust, you could make payments on it with the tax-free dollars, but car, you're more likely to get in a wreck, right? Someone could sue you. And if it's owned by the trust, then it's like, it's easier to penetrate and like start doing damage to it that way. A house, like,
doesn't like, but a foundation's got to have like a purpose, I think.
It does. Yeah. So when we set ours up, we have like, it's so broad. Like the purpose can be agricultural. It could be, I forget what the lists are. There's like 6 different things.
The only reason I know is because when I was doing wealth, so let me take like 3 steps back. So I first had the idea to do a foundation back in 2021 and not for taxes or anything. Just like I wanted a true, just nonprofit, for a cause. And they're like, all right, so what do you want it to be about? And I said, I don't really know yet, but something Christian based. I'm just like, I don't know exactly what it's going to be yet. And they're like, you got to know, you got to be like very pinpointed about who you're going to help, what you're going to do, what are the programs you're going to offer? How are you guys going to raise money? Is it public? Is it private? What are all these things? And I was like, dang, dude, I don't have the answers to these.
Yeah.
And they're like, all right, well, just, go back and think about it. And when you're ready, come back. And so like we thought about it and I said, honestly, nothing comes to mind right now. So I'm just going to put it on ice.
Yeah.
And so I put it on ice for years. And then Wealthy Kingdom came about. And originally I was just like, you know what, it'll just be a business and like, I'll just run it at a loss. I don't really care. Like the same thing will happen. But the problem is you can't really have anyone donate when you do it that way. And I know, like I started to get a lot of people who are like, dude, I want to support the mission and what you guys are doing. And I was like, okay, well, I might as well start going down this path. And then that way too, the stigma of it would go away of like, oh, he's just trying to make money off of faith. And I'm like, nah, this is like this whole other thing. Like you can go audit it. I don't really care.
Yeah.
So yeah, now we're there. And so when I went back 2 years later, I said, hey, this is what we're doing. Here's what we've already done. We're already got people going. And they're like, this is perfect. You guys have a clear mission. You have a way for people to join, all this stuff. And now it's just a matter of waiting. But I've also been told that anything that has the potential to self-deal, they're going to knock it off. They're not going to let me do it.
Right.
And so I'm just like, I mean, we'll see. But that's why I was like, man, how are you doing this without like a mission and all this? Because I'm already going down that path and it's really hard.
That's one of the rules, right? You can't self-deal.
Yep.
That's big. You can't do that. It sounds like it's 2 different foundations. Like yours is like more of a nonprofit. This is a private family foundation.
Yeah. And so we are going to be a public nonprofit that
Totally
anyone
different.
can donate to.
Yeah, totally different. So
Private's way easier.
Oh, 100%.
That's what they said.
100%.
They're like, but you're going to be public because you're trying to go like massive and get donations and everything.
Yeah.
Yeah.
Makes sense. Just 2 different things. But a lot of the same rules, like the self-dealing you can't do, right? I don't know if with the public one you have that expenditure rule or not.
I remember with the public one, because like with a private one, you could fund 100% of it. There's no like cap. You don't have to get other people to do it. But with the public one, there is a rule that you personally can only represent, like I want to say 20 to 30% of the donations.
Oh, okay. Yeah.
Meaning that you have to go out there and raise.
Got it. Yeah, so you couldn't just donate all of your money to take it off taxes for that purpose.
I mean, you could if you were getting in so much other stuff.
Got it.
So if I made $1 million, I would have to go get 2 million plus of donations on top.
Got it. Yeah. Makes sense. It's just cool things like this I wish they taught in schools.
Yeah.
Like this stuff intrigues me. And in schools we learned about like things we'll never use. This is real life things that people could use and could benefit from. Yeah. You just have to learn it. You have to take time and it's the stuff you have to seek. It'll never be taught in schools.
No.
Ever.
Dude, I was with some rich people one time. And anytime
I love
Yep. So I was
with some rich people one time.
Yep. So this one time I was hanging out with these rich people and it's happened. it happens a lot of times, but this was just one time that stuck out to me was, they're like, yeah, once you start learning like all these things that rich people do, you know, you'll learn why they don't pay taxes. And I'm like, what do? They buy real estate, and they're like, yeah, you know, obviously everyone does that, and that's a big part of it. And then like same thing, I'm like, all right, do they got like, you know, life insurance and stuff? I'm sure they got some of that. I'm like, yeah, you know, that's another thing. And then I'm like, okay, so what else? Then, you know, the foundation, I'm like, all right, you know, I knew that. And then they're like, yeah, you know, another one's art. And I was like, art?
Oh, yeah.
I'm like, what do these guys do with art? And I was just like, that went down a whole new rabbit hole of what these guys are doing. And yeah, long story short, it's like these guys will buy art and then like whatever, they buy it for whatever they buy it for. And then it gets appraised at some crazy value. So they might have only bought it for like, I don't know, $100,000. Let's just say only, but let's just say it was $100,000 from like some famous artist or something. And then it gets appraised at 500,000. And then they'll just donate the piece of art with the value at 500,000 to their whatever, their foundation or anyone's thing. And then now they just got a $500,000 write-off. And then guess what? The art is still hanging at their office in the house. It's still there. And I'm just like, okay.
Cheat code.
I understand what these guys do. Okay.
It's insane.
Yeah.
And it's not that difficult. It's literally just, it's not that hard. It really isn't. Like I go back to this all the time. Is like, I'm not the sharpest guy in the world. Barely graduated high school, D average. I was cheating off tests. Literally cheating off the wrong tests, obviously.
Yeah, wait, how do you're like the worst cheater ever.
Or like, I would just like the bubbles, you know, I had multiple choice. I would just like.
You're dyslexic.
I would just like.
Zigzag, draw something.
Yeah, maybe right down the middle. Somehow I passed the D average.
Yep. I wonder if they still got Scantrons. They do? All right. They still use
Scantrons. That's what it was. Yeah. So.
I'm surprised you knew
we're
that.
about the same age.
Yeah.
You're 34?
I'm 34, but I'm surprised you knew that, being such a bad student.
Yeah. But just like stuff like this, it's not that difficult. It just seems difficult because you don't know about it until
you don't know. You don't know.
Years old.
Yeah.
Right? When you're a kid, this would be so easy to soak up as a kid.
Yeah.
For instance, my daughter, she's had a policy since she was 12 years old, life insurance policy. So she hears me talk about it all the time with clients. Just hears about it. She's not sitting there studying me saying what I say.
Right.
I did a TikTok live with her, or maybe it was an IG live, where people would ask questions about infinite banking. And it was just her and I sitting on a couch. I had her answer the questions. And like, she would look at me and be like, was that right? And I'm like, yeah, spot on. Like, she knows the stuff better than 99% of people just because she learned it at a young age. Kids' brains are sponges, man. They learn so easily. As an adult, we learn something new. It's like, it's so complicated to us, but it's really not. It's just we're programmed. Everything else is right. There's a quote by Will Rogers is the biggest problem in America is not what people don't know. It's what they think they know that just ain't so. And it's true, because if you think about, everyone thinks 401ks, put your money in a 401k. That's what they think is a great retirement vehicle.
Yeah.
It's just not true. You're giving up access to your money now while it's worth the most because of inflation. It's going to be worth less tomorrow. Let alone when you're 60. Right? You're avoiding paying taxes now when you know what the tax rate is to pay the tax rate when you're 60. Who knows what it's going to be? Right? You're going to have to pay the taxes at some point. Pay them now when you know what they are. You're paying taxes on the harvest in a 401k instead of paying it on the seed today.
Yeah, the seed costs can be way lower today.
Yeah, but people are so programmed to think a 401k is the best retirement.
Yeah. What's that dude who's got like the billion? Is it Peter Thiel? Peter Thiel. His thing, his like self-directed IRA or something has turned into like billions of dollars.
Really?
I can't remember. I think it's him.
Self-directeds are actually pretty good. I like self-directeds. If you're going to do a retirement, I think a self-directed makes sense.
Yeah. And by the way, for anyone who, I'll put a link down below. For anyone who wants to do self-directed, we've got a, it's not even an affiliate. Like, it's just a company we refer our investors to.
Who do you use?
Horizon.
Greg Herleen.
Yep.
He's
so
the homie.
Greg's been on the podcast. And so, Yeah, by the time this releases, him and I are actually doing a webinar. But basically, like with the self-directed, you can get the money out of a 401k, right? Get control of it. Costs you nothing different. It just goes into a self-directed IRA. And then now you can go invest it however you want. You could put it in real estate. You could put it with us at Pineda Capital. You could do a ton of different things. But the point is, it's better for you to have control of the money than not. And so for me, it's like one of my new strategies with Pineda Capital. I'm really going to be trying to help people understand that. Whether they invest with me or not at Pineda Capital, I'd rather them have control of their money.
Self-directed is an easy thing for people to understand. I think it's really easy to understand that. It's just, people know what an IRA is. It's just self-directed. Yeah. You direct where it goes. Yeah. It's super easy to understand. And then, if you have control, you have less risk. Yeah. With anything. If you're driving your car and the brakes go out, you've lost control of stopping the car. So your risk of crashing goes up. Yeah. Right? You lose control of your money, you have a risk of losing it. So the more control you have, the less risk you have. So I think if you're going to do a retirement, self-directed makes sense. The only thing I don't like about it is you don't have total control. Meaning, if you do an investment, that profit has to come back to the IRA. You can't take it out. Yeah. Or you're penalized, right? That's what I like about infinite banking is like, you can use it for whatever you want. You go make profit in something, I can go
keep it.
I can keep it. I can buy some new clothes. I can take a trip with my wife.
Self-directed has a lot of rules for what you are allowed to invest in.
Yeah. So, but again, if someone's going to do a retirement account, self-directed, I think is the best way you could do it.
Well, like even if you already have a retirement, like, you know, you're working W-2, you've been building up your 401k, you got some money in it. It's like, well, why are you just keeping it in a 401k, like letting, you know, some other guy just hopefully make it grow 4%, you know, like take control of it.
Management fees and
take control of it. Like at least either invest it yourself, go buy a rental property, or give it to somebody that you actually want to invest with.
Right.
You know, whether that's me or whoever, but don't just take the 401k that your company gave you and just assume that they're actually doing what's best for it.
The funniest thing about those, man, is like the company wants you to put money in there because it's a write-off for them. Yeah. So like Danielle, my wife, has one, and I was like, stop putting money in it immediately. Like stop. Once I learned about like how money actually worked. Yeah. So she stopped. The company automatically like started the contributions the next year. And she noticed like,
why are we recontributing?
Yeah. She's like, this is weird. They just restarted it up. If you don't contribute anything, they started it for you because they want you to do that because of the match. The match is literally a write-off for them. Yeah. It benefits them. Yeah. Right? Mm-hmm. But they're matching something that you're not going to have access to for 30 years. Yeah. It's like, who cares? Yeah. So 401ks are the worst place you can put money, in my opinion.
I think, man, I want to say it's Peter Thiel, but he had like a huge, I think it's a Roth IRA. Let me see. Peter Thiel. Yeah, he's got a Roth IRA. It's amassed $5 billion in his Roth IRA. Wow. And really, the way it did it was he started putting his, you know, good investments in there way early on, like decades ago. And then all of a sudden, these investments, they popped, you know, like PayPal and all these things he invested in just went nuts.
And there's no taxes.
There's no tax on it.
Because it's a Roth.
Yeah. So he has just this $5 billion thing that maybe he paid, I don't know how much he put into it originally, but like, yeah, he did pay tax on, say, you know, the tens of millions that he put in. Right. Maybe even hundreds of millions that he contributed. But then its growth of this $5 billion has been tax-free. Yeah. And whenever he wants to access it, he'll get it tax-free. And I'm sure he's just continuing to use that money for his next investment. So that thing is going to be worth friggin' tens of billions.
And that's the whole thing that Greg talks about. That's Greg's whole thing at Horizon Trust. Yeah. So he's actually at the mastermind, I think, right now with Chris's thing. So,
okay. He was literally texting me today.
Yeah. You should stop by. I know you got the wedding tomorrow, right?
Yeah.
Stop by today. They're having something tonight, I think. It started at 4. I don't even know what time it is. What time is it?
It's 4. Okay. No, I don't know. It's close to 4. I'll stop by. I'm just I don't know. I'm busy with you right now.
I'll stop by now.
That's funny. Where are you guys at?
Virgin
Okay.
Hotel. Yeah, super cool. It was owned by Hilton. I didn't even know I had status with them. So we get to the front desk and like we got our room upgraded to like a suite. And I didn't even know.
It like changed.
Done.
It was, that didn't used to be Virgin. It used to be Hard Rock. Yeah, I think it was the Hard Rock.
Yeah, it looked like
So
it was
it's new.
redone recently.
Yeah.
Different flooring. You can tell like the walls look older because they're real textured. You know what I'm talking about?
Yeah.
And almost like I haven't looked. I think even the popcorn ceiling might still be up there too.
Well, you know what's funny is like, all right, just think about that, right? That hotel. It's like, how did that hotel get funded? You know, they probably used
Probably
IRA
from an
money,
insurance company.
money, like for real. Like that's
Yep.
that's where the capital got. Like it wasn't from us. Like it was from like some big insurance company funded it, or some big, you know, it wasn't a family office. Probably it was probably an insurance company, like you said.
Yeah, 100%. They got all the money.
Yeah,
I'm telling you, they
That's
got all
crazy.
the money.
It's crazy. Is there anything else people need to know that we haven't covered about like insurance or these crazy ways people are, what these elites are doing?
I mean, dude, we could go for hours. I'll need to take a potty break if we do that.
I don't. Well, you're already going to be late to your mastermind, but I thought like the art thing is funny. I think the captive insurance is interesting. I don't fully understand it, but I've heard people do that, and I've heard it's like, you know, just very complex to do. Another one I've heard is what is it called? It's like land, not entitlement, but rights. Have you heard that one?
No.
Oh, okay. There's ones where like you get these write-offs for man, I'm drawing a blank on what exactly it's called. But you could essentially buy like land. Let's just say the land cost, I don't know, $100,000, but then it comes with like $500,000 worth of rights. Maybe it's like the mineral rights and stuff. And then it's the same premise of art. It's like you paid $100 for it, and you can now just like go donate the land and get, you know, $500,000 write-off for the rights.
But then you own the rights.
Well, you'd be giving the rights to whoever you donated it to.
Got it.
In your case, if you donated it to your foundation, then yeah, I guess you still would own the rights. But the way I always looked at it was, okay, I mean, it kind of makes sense if you know, because you did have to pay $100,000. So, I mean, consider that basically like the tax. And so if you got a $500,000 write-off and you're at the 40% bracket, like, okay, you basically saved $100,000 because you had to pay $100 to do it.
Yep. So that's how mine was. Is my tax bill was going to be a certain amount. Mm-hmm. I paid $95 instead.
Yeah.
So it's like I saved about $400.
Yeah.
Made sense.
Yeah.
The only thing is there's a maintenance fee. So every year for the tax attorney to maintain this structure, I think it's 15% of the savings. So like if you save $1 million in taxes, you got to pay him $150.
Dang, this dude's rolling it in.
He's doing all right.
Dude, I want this guy's job.
But you still saved $850.
Oh yeah, you ain't gonna be mad about it. I just want his job. I want this guy's business, dude.
I don't, man. It hurts my head sometimes even talking about it.
Yeah.
And this is all he does. He's been doing it for like 30 years.
Yeah.
You know? So, but it's definitely a cheat code.
With your guys' for you as a guy who has life or who's doing infinite banking, do you guys make a residual every year on all the client? Okay.
10 years.
10 years.
Yeah. So that's where it gets good because the longer you're in it, longer you're in the game,
Yeah.
your renewals become just stupid.
Yeah.
I've only been in it for 3 years.
It's just going to keep compounding for you.
Yeah.
Do you make more though up front?
Yeah. First year you make the most.
Yeah.
And then year 2 through like year 5, it's considerably less.
Yeah.
And then like year 6 through 10
It goes back up.
it goes down even more.
Oh, it goes down even more.
Yeah.
Okay.
Yeah. So you make the majority first year.
Got it. But there's still a little residual.
Yeah.
And then are you doing any kind of like downline stuff?
Starting to.
Yeah.
Yeah. Starting to. So building out teams and just different partnerships with, I've got like a husband and wife that have their own coaching platform for real estate. Mm-hmm. And they're getting a policy and they're going to actually have all of their clients feed through my downline. They'll get paid commission off of all of them.
Yeah.
But then they'll be my downline. So I'll get like a cut of everything. Exactly how Chris is doing right now with me.
If somebody wanted to get started, what's the minimum that they need? Like when does it start to make sense?
Really starts to make sense about 10 grand a year.
So you're going to contribute 10 grand a year. Do you have to pay like a fee on top of that, or is it like it's just 10 grand?
Just 10 grand. So you plop in 10 grand, you got access to probably 7 to 8 grand of it right away.
Yeah.
Use all 7 to 8 grand.
Because the 2 to 3 is like the cost of doing it.
Yeah, to get the death benefit.
Yep.
So that doesn't have any cash value right away. It does over time.
Yeah.
It takes like 5-6 years before that 2-3 grand starts building cash value.
Yeah.
But the overage, the 7-8 grand that you're putting in above and beyond, that's instant cash value.
And then the next year you put 10 grand again.
Yep. And then the cost didn't change. So you've got access to like 7 or 8 again, whatever the liquidity is, plus the growth from the 10 grand the first year. Right. And then once you start getting into where that 2-3 grand starts building cash value, that's when it gets good.
Yeah.
Because you're getting all the growth from the compound interest plus your overage that you're putting in each year, your paid up additions.
Yeah. So you're saying that 2 to 3 grand you're paying every year for your cost is starting to finally make sense in year 6, 7.
Yeah.
Okay.
Yeah.
So it is similar to what I was hearing before.
Yeah.
But it was just the death benefit.
They had a
way less.
higher cost.
Right.
So it took longer for that to make sense.
Right.
So the lower that is, the more liquid the policy is right away.
Right.
The higher that cost is, the more liquid the becomes later on, because you're contributing more later on.
And the overage money that you're putting in, does that get taxed?
No, there's no tax on any of the growth. No tax on the use, no tax on the growth, no tax on the death benefit. You just pay taxes when you put the money in. So it's like post-tax dollars.
Yeah.
Unless you have the foundation structure and trust structure like I have, then I'm paying the policies with...
Yeah, a lot of these IRA account or retirement accounts are either pre-tax or post-tax, right? So pre-tax would be, hey, you're not paying any tax. This is actually going to be like a write-off for you today.
Yeah.
Problem is, down the road, if it grows, you'll get taxed then.
Yep.
And then, post-tax would be, hey, I am paying tax on this money right now today, but its growth will be tax-free.
Right. My opinion, that's the best way to do it, because you know what the taxes are today. You don't know what they are in the future.
And you're just expecting massive growth.
Yeah.
So you would expect that if I put, I don't know, $1 million in, it's like, yeah, I paid tax on $1 million, but if I have, 10 million when it's all said and done, and I have no tax on it, like it's
much rather have that.
Yeah. Versus 10 million on the tax, tax on the 10 million.
Yeah. Much rather have that.
Yeah.
It's the whole notion that people say like, oh, well, when you retire, you'll be in a lower tax bracket. Then you're just basically saying I'm going to be broke. You're going to be broke. Why would you do that?
Yeah.
Right. Your whole goal should be when you retire to like live abundantly.
Yeah.
But also do it while in your working years. That again is why I don't really think like a self-directed is the best thing, because you can't fully control it while you're not retired before 59 and a half.
Yeah. You can't use the money to like live or anything.
Yeah.
Yeah. It's just pure investment.
Policies are great because you can use it for whatever, whenever. And then because of how long you've given it to grow, the compound interest is stupid. Like I've got policies where when I'm like 70, I'm probably not going to be working. I probably won't want to be working like crazy. Right. Who knows? But at 70, I can put in like 50 grand. The growth is like 400 grand.
Right.
So I could put in 50, immediately take out 400 as a loan. Like
Wait, repeat that. Go on.
So if I put in 50, the policy grows by 400.
Why?
Because of the compound growth. The compound growth for my entire life up until 70 never stopped. I kept putting in that 50 grand a year.
Right.
So it's just more and more growth. So that year when I put in 50, bumps up by 400 grand. That's all the growth.
The lifetime benefit?
No, it's just the growth from the year prior. You don't have access to the growth until the end of the year.
Okay.
So like when I put in 50, I'm accessing all my growth from that prior year.
You're saying the prior year you grew 400K as far as like, because you've been putting in 50K every year for like 30 years.
Right.
Right. And so what you're saying is, let's say your principal in is, what would that be? 50K? Let's just say 20 years. So $1 million, right? So you've put in $1 million and then it's growing with interest, compound. And so maybe the million is worth, I don't know, 3 million, 4 million, 5 million. I don't know.
Yeah.
So what you're telling me is like if it was worth 5 million this year, a year from now, it's worth 5,400,000.
Exactly. So now that's what's compounding.
Yeah.
Right. So then I'll have access to even more the next year.
Yeah.
So it's a beautiful thing because then as long as you keep paying premiums, you'll always have a death benefit.
Right.
So think about what I just said. If I put in 50.
And how much is the premium at that point?
It's the same. So the
2
premium,
to 3K.
yeah, it never changes. It always stays exactly the same.
It's like my term. It's just
exactly.
It's 2 to 3K. Exactly. That just is what it is.
So like, let's say if that premium was 50 grand, like I just said, and it spits off 400 at 70 years old, I can just take of that 400 grand, 50 grand of it to pay next year's premium. I'm using the growth to pay the premium. I just keep the difference as tax-free income because loans aren't taxed.
Yeah.
So $350,000 at 70 years old, I just got as tax-free income, and my premium's paid for the next year. So I'm going to get
because you're giving
more.
it to yourself as a loan.
Yep.
Whether you pay it back or not.
And then 50 grand of it, I'm going to give back to the insurance company as premium.
Because you have to keep paying your premium.
As long as you keep paying the premium.
But you don't have to even pay 50 grand. Because your premium's 2 to 3 grand.
Exactly.
The 50 grand is just you wanting to keep growing it.
Yeah, you're just continuing to pay the premium so that it keeps growing.
Yeah.
And the numbers are arbitrary. So based whatever the numbers are.
But I'm just like, because the premium does not include you overpaying and overfunding it.
Right. Overfunding is only possible for like 10 years.
Oh.
Yeah. So like that policy I just explained, that's 125 I can put in for 10 years. After 10 years, so you're 11 for the rest of my life, I can only put in 50. That's the premium.
50K is the premium.
Right. So at 70 years old, if it grows by 400, I can just take that 400 as a loan, keep 350 of it as income, take 50 of it to pay the next year's premium. So then that next year, because I injected another 50.
Yeah, the 50K is, though, that's just a sunk cost. That's just the cost of doing business.
But then because I'm continuing to add more premium, I'm continuing to get more and more growth. So the next year when I'm 71, it might be like 430,000. Take that, 50 of it pays the premium. I keep the difference, 380. So literally my income keeps rising the older I get, as long as I just take a portion of that.
It's because it's from the overfunding early on.
Yep. And it never stopped compounding.
And what's it being invested in? Just the insurance companies just paying you that guaranteed 3.25?
Plus dividends.
Plus the dividends.
Yep.
That's how it's compounding.
Yep.
And so you're taking the compound from that, just say 400K a year, and then you're using part of it to pay your premium. And you could keep it in there and let it compound even harder.
Right.
If you really wanted to. But you're saying, hey.
This is more of like a retirement play.
Yeah.
So like when you retire, if you didn't retire until you're 80, 85.
It just kept compounding.
Then it's just.
Even crazy.
Exactly. So it's delaying that gratification. Like my policies now are at a point where I could technically retire because they're growing more than the cost of the premium.
Right.
Like I just had one where we put in 125 and, or no, it was 150. So it was a policy on my wife, put in 150, it grew by 177. So I could technically take the 177, 150 of it, pay next year's premium.
Your premium is 150?
That's with the overfunding.
Okay.
So that's the first 10 years. The premium 60, the overfunding is 90 grand.
Got it.
Right?
And 150 is the max you could overfund at like a 90K or a 60K premium?
On that policy. Right.
Okay.
Yep.
Got it.
I could technically just have 27 grand of tax-free income right now off that policy, but then I'm stunning the growth.
Yeah, it's not going to compound.
Yeah. If I wait.
It would kind of just stay the same.
If I wait, it would just be bigger numbers.
Yeah.
Yep.
That makes sense. Well, dude, actually that answered quite a few questions. Maybe I'll even tell Chris that, hey, my guy, Mr. Burr, he explained it better. And maybe I'll say that, maybe we'll have it on camera. I don't know. But I'd like to hear what he says about it.
You heard it here, people.
just clip it. But no, that was insightful. I actually did learn quite a bit. And, if anyone wants to do it, we'll link your stuff down below. So cool. Definitely check it out, guys. And if you're interested in doing whole life, hopefully, by now, I probably asked every question you might be thinking. You asked every question that everyone it's always the same questions. Yeah. So I would like to think I think deeper than most people, but it's all good. I'll ask the basic. You know what? I was just thinking basic level for the people.
It's always the same questions, man. So
yeah.
Once people finally get it, it's like it's the best thing since sliced bread once you finally understand it.
But I'll add as a caveat, the only way it really starts to make sense is if, you're starting to make money. Like you still got to make money in something, right? Like you got to have some kind of career or skill or business or thing that you're making money on.
It's not going to make you rich. It's not an overnight thing.
No, it will only make as much as you make over here.
Right. So you have to be able to fund the policies in order to be able to borrow against them.
Exactly.
So if you put in $100,
you ain't gonna be rich.
What are you gonna borrow? $70? Like you just can't do much. So that's why like 10 grand starts to make sense. The more you put in, the more sense it makes.
Yeah.
Because then you just have bigger numbers you can start using.
That means you're making more money over here too.
Right. So I always tell people they should have two businesses. One business is the business they make their money in.
Yeah.
The second is the business of banking, how that money flows.
Yeah.
And that's infinite banking. If it flows through a policy and comes back out through a policy, inevitably, you're just going to make a lot more money because your money's running in tandem.
Yeah.
You're making money in your business, whatever you do, flipping couches one time, right? Isn't it? You used to do that?
I'll flip that, yeah. I'll flip that couch you're sitting on right now.
I'll flip that.
Yeah, I'll flip anything, dude.
I'll flip that. But yeah, so like you make money in whatever you do.
Yep.
But then you also have your money making money in infinite banking.
Yeah.
So they're running parallel.
No, I understand.
So it's crazy once you really understand it and once you really get it.
Yeah.
And I've had the pleasure of helping 1,600 people do it. It's been cool.
Yeah. Well, guys, go check him out. We'll link to it down below. Mr. Burr on all of the socials. And make sure to subscribe to this. And hopefully you enjoyed the conversation. We'll catch you on the next one. Peace.
If the goal of life is to get as rich as possible, there are certain rules that make sense. Don't pay your house off. Maximize. Real estate rentals were a business back in